Hello and welcome to another episode of The Dana Yee Show. If you've never seen my face before, on this channel I talk about everything money and finance, and in this video I'm going to cover different types of ways you can invest in the stock market and what the best way to invest in the stock market is. If you learn anything or are hopefully slightly entertained by these types of videos, make sure to subscribe, and if you enjoy this video in particular, make sure to bop that like button, as a lot of time, planning, and effort goes into these videos. As always, I am not a financial advisor, so don't take anything I say in this video as financial advice. I'm just here to educate and hopefully entertain. One thing I will note is that this video covers ways you can invest, and investing is inherently different than trading. Investing, you plan to buy and hold for the long term, whereas trading, you're generally buying and selling very quickly. If you want to see different types of trading, make sure to check out a previous video that I made. In terms of how I ordered this video, I went from the least risky to the most risky, and this generally correlates to lower returns versus higher potential returns. And once I get to individual stock investing, I'll split it down even further into types of stock investing. So firstly, we've got bonds. Bonds technically aren't part of the stock market, but bonds and stocks are sometimes correlated and they're included in a lot of investment portfolios, so I decided I would touch on it. There's a lot of verbiage here, but essentially a bond is an IOU, and bonds have what are called maturity dates. So if you've ever heard terms like the 5-year treasury bond or the 10-year treasury bond, that's essentially referring to the time until maturity of that specific bond. So for example, if you had a 5-year treasury bond rated at 2%, that was a terrible way to write 2%. At 2%, the government is like, hey, if you let us borrow $100 in 5 years, we'll give you back $102. So that's 2% after 5 years, which obviously isn't a great return. It's generally very conservative, but it's very useful for a lot of people nearing retirement like bonds because they tend not to fluctuate as much as stocks. And if you want some exposure to the bond market, Vanguard has an index fund. It's called the Vanguard Total Bond Market Index Fund, where essentially it has a ton of bonds in it and it yields 2.18% annually. Now onto a very popular type of investing, index fund investing. Firstly, what is an index fund? It is essentially an investment that tracks a market index, hence the term index fund, and it's usually made up of stocks or bonds, and indices usually track one specific thing. For example, under the large US stock sector category, the S&P 500 is an index that tracks the 500 largest companies in the United States. So think your Apple, think Tesla. The Dow Jones Industrial Average is an index that tracks a lot of industrial companies. So think Boeing, think Exxon, think Walmart. And lastly, in this small list, we have the NASDAQ Composite, which tracks a lot of large tech companies in the United States. So think Tesla, think Amazon, think Google, think Facebook, think Netflix. And there are tons of different indices that track tons of different things. And index funds can be broken down into essentially two large categories. We have mutual funds and ETFs, or exchange traded funds. Both have the advantage of diversification, and mutual funds are managed by a group of people. I believe mutual funds and index funds were popularized by Vanguard, so random little fact there. And if you have a 401k, 403b, you probably know what a mutual fund is because a lot of employer-sponsored retirement plans go into mutual funds, and some of them are actually restricted to only mutual funds that you can buy. Slightly different from a mutual fund is an ETF, or exchange traded funds, and both of these you can kind of think of them like a basket of stocks. So by buying this one thing, you're buying a basket of 500 different companies. ETFs are slightly different from mutual funds because ETFs are traded like stocks, so they fluctuate all day. So you can buy an ETF at 9:30 and sell it at 10 o'clock, whereas a mutual fund, you can only buy it once a day after the market closes. But these mutual funds and ETFs are the two main categories of index funds, and they offer a lot of diversification. So if you don't really want to put a lot of time into choosing your own stocks, these are generally a safe bet, as we have seen the US stock market have an annualized return of about 7 to 8%. Some examples of mutual funds and ETFs: on the left we have VT-SAX, or the Vanguard Total Stock Market Index Fund, which essentially tracks the entire US stock market. So for the price of $101.25 from March 16th, you can be exposed to the entire US market. On the ETF side, a very popular ETF is called ARK-K, or ARK Innovation ETF. So this is Cathie Wood's flagship ETF fund. And again, to summarize, for index funds, whether it be mutual funds or ETFs, the benefits of them are that they are very diversified and it takes very low effort on your part to get these and be diversified. Okay, so now we are on to the different types of investing in individual stocks. So if you're interested in individual companies, or you want to be a little bit more involved in your own investing, picking individual companies and individual stocks is probably the way to go. And even within this category, there are different ways to do it. So the ones I'm going to cover are growth, value, dividend/income, and dividend growth. Oops, didn't mean to cross that out. Firstly, growth investing, as the name would suggest, is where you look for companies that are expected to grow at an above average rate compared to the industry on a broader market. And generally, this is like smaller companies because smaller companies can grow faster, whereas if you have a behemoth company, it might be harder to grow 50% in a year. Some examples of what I think are growth stocks. Now, feel free to disagree with me. I think Tesla is a growth stock. Yes, Tesla has risen a lot. Even at such a high valuation, I think Tesla has room to grow. Similarly, Amazon, despite how large of a company is, it's valued at $1.5 trillion. I think Amazon can grow so much. Next is value investing. This is a little bit different from growth investing. This is essentially where you try to pick stocks that appear to be trading for less than their intrinsic or book value. As I briefly mentioned in a video before, stocks are not traded at their fair value, whatever that may be. Naturally, some companies may be overvalued, some may be undervalued, and value investors try to pick companies that are undervalued. One value stock I think right now is Apple, and again, despite the fact that it's a $2 trillion company, I think it's undervalued right now. Its PE ratio is only 33. In the tech industry is relatively low, so I think Apple can continue growing. A very famous value investor is Warren Buffett, and this is just his Berkshire Hathaway, kind of like a mutual fund. So you invest in this and then he goes and invests your money. And if you look at the returns since its inception, this has been incredible. This mutual fund has seen a lot of growth, and one share right now is $381,501. Next, we've got dividend and income investing. So what is dividend investing? Dividends, if you don't know, is essentially where a stock, ETF, or company pays you for being a shareholder. So dividend investing is a strategy of buying stocks that pay dividends in order to receive a regular income from your investments. And I lumped dividend and income investing in a group because I see this group, so dividend income, is essentially they want to make as much money as possible from their portfolio. Obviously, that's kind of the goal of everybody. I guess I should say they want their portfolio to pay them as much as possible. For example, a really well-known dividend company is AT&T. Their dividend yield is 6.9% right now, which means that if you invest $100 into this company, you will earn $6.90 every year. However, one issue I see with pure dividend companies is that they don't really grow that much. So if you look at AT&T since its inception, it opened at around $60 and it's been trading essentially at $30 for like 17 years. So you won't see a lot of growth with this company, but you will receive generally large dividends. Another way of doing dividend investing is via something called a REIT, or a real estate investment trust. As you know, real estate is very expensive, and if you don't have the time or money to purchase property and manage yourself, a REIT is a much easier way to go. And a REIT essentially piles investments from all of its investors and buys properties and rents them out and then distributes the rent among its shareholders. And you can buy them just like stocks. So for example, one of my favorite REITs that I have is called NHI, or National Health Investors. They invest in a lot of health facilities such as senior nursing homes, and they're moving into medical spaces. They offer a 5.77 dividend yield. So for every $100 you invest, you'll earn roughly $5.77 a year. I also like this company because I see health as an industry that's never really going to die down. People are always getting older and we're always going to need medical facilities. You can't really do surgery online. And since I've bought an NHI, it's actually been up 19.74%. So I'd say that's pretty good. One other way for generating generally really high income from your portfolio is via different ETFs that have very high yields. So for example, there's one called QYLD, or the Global X NASDAQ 100 Covered Call ETF. Its current yield is 11.49%. So for every $100 you invest, you will earn $11.49 a year. And the way they do this is that they sell covered calls on stocks in the NASDAQ 100. That may be a little complicated now. Hopefully I want to explain them in the future. Another example is something called RYLD, or the Global X Russell 2000 Covered Call ETF. And I think the Russell 2000 is small cap companies in the United States. I'm not actually 100% sure. And currently its dividend yield is 10.57%. So income ETFs like this offer very high dividend yields. Another method that I kind of do myself is called Dividend Growth. And I separated separated this from dividend income because in dividend income, you're looking for the ETFs, the companies with the highest dividend yield so you can get the most money in a year. Dividend growth is a little bit different. Essentially, a company that pays dividends, if it grows year over year, they're able to increase their dividends. They generally increase their dividends over time. And in addition to them increasing their dividends, you generally see the company value itself grow over the years. So this is the best of both worlds, in my opinion, because you're getting paid more and more dividends over time, and your stock is appreciating in value more and more over time. So one example of this is Apple. I love using this as an example for pretty much anything. It does have a generally low dividend yield, but if you look at the dividend history of Apple, its dividend has been increasing steadily year over year. Even though Apple isn't a large dividend company, I think it falls in the dividend growth category because I believe that they'll continue to raise their dividend over time, and as a company, they'll continue to grow over time. Okay, so now for what is probably the most risky way to invest, but you can see the largest returns, are using options. Options can be used to invest, not just trade. Options are complicated, and I do want to break them down further on this channel, but two investing strategies with options that I wanted to touch on briefly. One is leaps, or oops, I keep crossing stuff out instead of highlighting it. Are leaps, or long-term equity anticipation securities. The specifics aren't super important, but with an option, it has an expiration date, and a lot of people who sort of gamble or trade options trade with very short-term expiration, so they might buy an option that expires the next week. However, leaps are essentially very long-dated options, so you can buy an option that expires in 2 years. You can think of one call contract as essentially owning 100 shares. So if I give the example of Apple, if you wanted to currently buy 100 shares of Apple, you would need about $12,000. However, if you wanted to buy a long-dated options contract on Apple, let's go into roughly 2 years from now, you can see that the 125 calls are about $23.10 per contract, so that's going to be $2,310, which yes is still a lot of money, but essentially it's like owning 100 shares. So instead of buying 100 shares of Apple for $12,000, you can buy a call that expires in 2 years for $2,300. Another way to use options to generate income is something called a covered call. This is actually my favorite way to generate income using options, but you can sell covered calls based on shares that you have. And if this doesn't make sense, I'll just give a quick example and hopefully explain it more in a future video. One example for me is Palantir. I own 100 shares, so I'm able to sell a covered call. And what all of this means is essentially I sold a call that expires on March 26th with a strike price of $30. This -1 means that I sold it and I received a credit of $49.35. I like to think of covered calls as you're essentially getting paid to hold shares of companies that you like. I hope that wasn't too complicated, and if you have any questions, make sure to leave them down below so I can dissect any questions you have in potential future videos. Anyway, in conclusion, I don't think there is a best way to invest in the stock market. I just made that the title because I think that's more interesting than ways to invest in the stock market. But it ultimately depends on the person, and the two factors that I think are the most important in determining how you should invest is what is your timeline for investing and what is your risk tolerance. So for example, if you are about to retire, it might not be the best idea to do individual stock investing and go for growth companies, because growth companies tend to move a lot on the daily. Whereas I'm younger, so I have a lot more time to invest. I'm looking to invest for at least 20 years. I have a long-term horizon, and I'm not really concerned if a company goes up 10% today and down 10% tomorrow. I think it's going to grow a lot more in the long term. Secondly, it depends on your risk tolerance, and this is completely different for every single person. I think my risk tolerance has increased over time. When I started investing and I saw a stock go down 3%, I was like, oh my god, gotta sell, it's going down to 0. Oh my god, get rid of it now. And now I'm just like, down 10%? Nice. And this just differs from person to person. If you're able to stomach the ups and downs of really volatile companies, I say go for it, especially if you believe in them long term. But generally speaking, if you're investing for only a very short amount of time, so if you're nearing retirement or you need the money soon, I would go with something more conservative. Again, not financial advice. If you have a much longer timeline, you can afford to be more risky in potentially things that will grow a lot more. And similarly, if you hate seeing your portfolio go down 2% in a single day, do not buy stocks that move up and down 5%. You won't be able to handle it, and you'll be checking every day like, oh my god, do I sell? What do I do? And you can always mix and match different strategies. There's not always one. I personally am a mix of dividend growth, value, and options investor. So I hope you enjoyed. I hope you learned something. Let me know what type of investor you are, and I'll see you guys soon.